Get off the sidelines and take control of your financial future at www.tackletrading.com. Get in the game.
All right, so every quarter, okay, public companies, I don't know why I put a comma there, public companies report earnings, okay, the revenue, which is called, I believe that's top line, isn't it? And then their earnings, which I believe is the bottom line. And Wall Street reacts, right? Wall Street reacts. So most earnings reports are delivered at the end of, after the quarter, so at the beginning of the next quarter. So January is when they report Q4. April is when they report Q1. July is when they report Q2. And October is when most companies report Q3. Those 4 months collectively make up what we call earnings season. Earnings season. This is where the bulk of public companies prep the books and pull up the skirts and give everybody a bit of a show and show them what's going on behind the scenes and how much money they've made. Okay? So at the end of the day, when you think about fundamentals and what drives a stock higher, if I buy Apple, I'm a part owner of Apple, and I have rights to profits. Okay, the only reason people buy shares of a company is because they believe that company is going to make money over time, and that money will be returned to shareholders in some fashion. If the company does better than expected, you can bet that Wall Street's going to get all giddy and bid the price up. So because of the drastic importance of earnings, these announcements have a large impact on the stock. Okay? Now, earnings announcements are binary events. Binary events. Okay, they have 2 potential outcomes, each with a 50-50 chance of happening. Okay, it's always a coin flip. It's always a coin flip. Okay, so a novice mistake is to say, I know Apple will gap up because it's going to make a lot of money, right? Well, that's not true. Maybe they will make a lot of money. That could be true. But you still don't know how the market's going to react. We could go so far as to say even the CEO of the company doesn't know how the market will react. Okay? Sometimes the company beats estimates and seemingly reports good news and the stock goes down. Sometimes the company misses estimates and seemingly reports bad news and the stock goes up. Wall Street is a fickle place, okay? And so you need to just treat earnings as crapshoot, 50-50, could go up, could go down. That means we don't really have an edge predicting direction into earnings, okay? And you don't have to take my word for it. We got earnings season over the next 3-4 weeks. Go pick 20, 30, 40 different stocks. Guess which ones are going to go up on paper and buy them. Guess which ones are going to go down and short them on paper. Dollar to donuts, you'll probably discover you're right half the time, you're wrong half the time, okay? And so it's a game that I'd rather not play. Right? It's a game that I'd rather not play. So not a big fan of predicting direction into earnings. Okay? Because you have situations like what Rich says. Hey, IBM reported their first growth in 23 quarters. Why the heck wouldn't they go up? Well, Rich, I don't know. Okay? Now, we could make up a story in hindsight. We could say, oh, that's because even though this positive news, blah, 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 well, there was this negative thing. It's like, really? That's why all the people sold? Like, what did you do? Poll them? You call them up individually and say, hey, Jim, why'd you sell? Hey, Sally, why'd you sell? Was it because of Buffett? Was it because of this? Was it because of that? Really, you don't know. Okay. I mean, there's so many different people that trade, so many different motivations and objectives. It's impossible to know exactly why somebody does anything, right? So what the news does is they just pick up on whatever seems to be the most plausible explanation, and they say, hey, despite IBM beating expectations, it fell because of blah blah blah, right? I don't even know what the details are on IBM. Just using that as an example, okay? Yeah, sometimes it is, right? I mean, it's like, well, great, you made money last quarter, fantastic. Well, what are you going to do for me next quarter, right? So because there's so many variables, how do you know which one that investors are going to pick up on? Which one is going to be the most important variable? You don't, right? So you just don't play the game, right? You just go into an earnings announcement with the understanding that we'll see what happens. Could go up, could go down, okay? But, I prefer not to make the guess, okay? Or at least, place money on. Now, that being said, so that's point number one, okay? Point number two would be long-term investors that hold for more than 3 months are, by default, holding into earnings announcements, okay? So over the long run, good companies tend to go up more than they go down, right? Up gaps are either more common than down gaps, or down gaps are turn out to be buying opportunities in hindsight. So if I'm a short-term trader, not a big fan of holding into earnings, but obviously if you're going to own stocks long-term meaning more than 3 quarters, you're owning it for years and years and years, earnings is noise, right? So I'm not necessarily saying that every trader should automatically sell every stock they own because there's an earnings announcement coming up. I mean, when you look longer term at a stock like Apple, it's like, can you even tell where the earnings announcements are over the last 10 years? I mean, I'm sure that there's some of the times it gapped up, some of the times it gapped down, but it was a good company. They kept making more and more money. So over time, they tended to rise despite the occasional setback on a bad earnings release.